with Evan to kick off and provide us with a market overview. Evan?
Great, thanks, Brian. And if we maybe flip this to page 3. So, I think just current market conditions in the public markets and even the private markets, frankly, there has been a ton of capital flowing into life sciences companies. If you think back to right around the initial term of COVID, the market tanked, across every industry. But I think what you saw is life sciences companies in particular roar back. And, over the last several months, there's been an, unprecedented record number of IPOs and the sizes of the IPOs that have been getting done, most of that, being in healthcare. And, while there's money flowing into the market today, obviously, when you think in terms of IPOs versus other alternatives, you never know if by the time you're prepped and ready to go, if that IPO window, especially for life sciences companies, will remain open. We could switch to the next slide. And so when you think about your alternatives to doing an IPO, I think one thing that's becoming a much more common alternative is this reverse merger with a life sciences biotech shell. So, as opposed to, and obviously SPACs, which we talk about later, are coming more in fashion, there's always, the life of biotech companies that have clinical trial failures and are sitting there with a public shell with a bunch of cash. And oftentimes it's just a much more efficient alternative for both the private company that's looking to go public as well as the public company with what to do with their cash to come together and approach one of these processes. When aside from just, this slide talks about, and oftentimes, you have companies that are close, they have an S1 on file and the IPO got delayed and they opportunistically take advantage of this to go out with the market where they can get it done. I would also say that there's more and more common, you're seeing companies opportunistically approach these these reverse mergers where maybe they wouldn't quite be ready to file their S1 and pursue an IPO path. These reverse mergers obviously come opportunistically, I guess unfortunately for the public company, but opportunistically are available large cash balances and public companies looking to transact. And so a lot of times private companies who they may be a little bit earlier than they were thinking definitely are considering this path. With that, I think we can flip to no questions. I think you're on mute.
I apologize. Can you hear me now, Evan?
Yep.
Sorry about that. So before we go too much further into life science reverse mergers, it's important to distinguish it from a reverse merger into a shell company. Historically, that had been done. Next slide, by the way, Melissa. Historically, so that had been done and considered a backdoor IPO for many years, and it raises a significant number of concerns, liability concerns for the company that is going public. So it's important to define what is a shell company under the securities laws. So shell is defined under Rule 405 of the Securities Act and under Rule 12b2 of the Exchange Act. So as defined, a shell company has no or nominal operations and also either has no or nominal assets. Assets that are nominal can consist of cash essentially or cash equivalents, but there's no business operations and there's no significant non-cash assets at that level. Shell companies are essentially formed for the specific purpose of effectuating a reverse merger. They're also known as blank check shell companies. So most reverse mergers in the life science space that we've seen over the last several years don't involve that kind of a shell company. Rather, the life science reverse mergers we've seen have involved a public company that previously had a prior business strategy, plan, assets, operations, but only recently terminated those operations and only recently has essentially nominal assets or operations. Typically, this is as a result of a failed clinical trial or something, having gone wrong, essentially. So they had previously conducted operations that were either disposed of or terminated, all of which are publicly disclosed. And now they are looking at strategic alternatives or opportunities to merge with another private company that does have ongoing operations, but is in need of a cash infusion or other, financing, and is keen to also go public as part of that transaction. So a central concern is laid out here on the slide for privately held companies identifying a shell company with which to do a reverse merger is whether that shell company is free of liabilities. So upon closing of that merger, the surviving merger company is going to bear all of the liabilities of that shell. And even post-closing indemnification for those liabilities has a limited impact and is unlikely to be very available, frankly, to the pre-closing shareholders of that company. Shell companies, as we note at the bottom of that slide, are also limited by securities laws, which are not applicable to dormant public companies, which again is what we see more typically in the context of a life science reverse merger. Specifically under Rule 144I of the Securities Act, if a company has ever reported being a shell company in the past, investors in that entity cannot resell unregistered securities under Rule 144 until that issuer has been current in its SEC obligations for at least 12 months. So it's a very important liquidity point for the private shareholders to understand if they are entering into a reverse merger with a shell company. Again, that consideration, next slide, Melissa, is not applicable in the context of a dormant public company that is not a quote unquote shell company as defined under those SEC rules. So here, we further distinguish among reverse mergers. The other benefit that the private company is seeking out is the stock exchange listing. Unlikely to get a stock exchange listing of much value from a shell company, perhaps, but typically your dormant public company is listed on NASDAQ or on the New York Stock Exchange, and that provides additional value as it makes it easier for the private company to step into the shoes of that dormant public company. The stock exchange still must review and approve the transaction, but it is typically an easier process than it would be if one were starting from scratch as part of an IPO or direct listing type process. So with that said, I'll pass the presentation back to Evan to talk a little bit about the rationale for these types of transactions and the structural considerations. Evan?
Thanks, Brian. So I guess first things first, we're talking about, alternative path to an IPO. So stating a little bit of the obvious, the goal here is one, accessing a sizable cash balance, and two, getting public, right? This is a way to get public and kind of secure a specific amount of cash. How it's different and in some ways beneficial to an IPO, in one way is obviously you're not paying the 6 to 7% financing cost underwriting fee spread for going IPO. But when you think about as well, your traditional IPO discount, where you're kind of priced in such a manner where people want to buy into the stock and you're priced to the lowest common denominator to fill out a book. Here, you're negotiating with a distinct group of investors in a fair arm's length negotiation. And when you think about, a lot of times these are done concurrently with concurrent financings. When you think about how that financing is priced and how in some ways, the reverse merger plus concurrent financing starts to look a little bit like a crossover round plus an IPO, with the crossover round where you may be pricing that at a discount to the IPO, which is itself a discount. Here, you're accessing the sizable cash balance without taking that discount because you're doing it oftentimes all at the market price. And, another key point here is, again, this starting public valuation really speaks to that point where people can tell based on, while you're only, the press release that comes out when you do these reverse mergers only shows the ownership, pro forma ownership of both the private company that's merging into the public company and the public company. Implicit in that exchange ratio and ownership split is a market cap. And so you have the ability to kind of fix what your starting public valuation is on day one, oftentimes, well in advance of the whole pricing process during an IPO. And as I mentioned earlier on, this does give you the this is an opportunistic transaction in most cases. This isn't something where you can say, I want to go pursue a reverse merger that has $50 million of cash, and there's going to be one every, at any given time. These are companies, clinical trial failures are occurring at various times, although, unfortunately, it's a common occurrence. So there are these to pursue, but a lot of times what you find is that private companies who otherwise may have waited to get that data card before deciding to file and go public, this allows them to get public, get fully financed through that milestone, and then enjoy the appreciation in the public marketplace and the attention that comes with staying public once they're already public and get to flip over that data card. I think with that, we can switch to the next slide and talk a little bit about structural considerations. So, just a couple of key points to talk through in the parameters. The number one factor here when you start thinking about these reverse mergers, it's a stock for stock transaction. So you're getting stock in another company. So it all comes back to an exchange ratio. And, there's two common ways that these are done, although one way is becoming much more common. When I say fixed exchange ratio, that's more or less it's 40% to the public company, 60% to the private company, and there's no change regardless of net cash, as long as there's a certain net cash threshold met and the other obligations of the contract are met. What oftentimes happen, and you see this much more common nowadays, is with the private companies, because they're pursuing this more as a true alternative and not because they couldn't necessarily go public or do a SPAC, but truly as a viable alternative to these, they're being more aggressive they have the ability to be more aggressive in their demands, and so can more aggressively negotiate what the parameters look like. And so the deductions such as D&O insurance, where that may have been something that the private company the public company would get credit or wouldn't have to deduct from their net cash for, they can now, they're now being forced to take deductions across the board. And what that leads you to is this sliding scale where, if a company meets a certain net cash threshold, the agreement is locked into a certain ownership split. But as it trips either above or below a certain threshold, you see adjustments. It's typically dollar for dollar in terms of some formula that's disclosed in the merger agreement. The benefit here as well is that this really provides transparency for third-party investors to look at the formula and imply more specifically what the cash was attributed, and then they could do their own math as to post-money evaluation for the transaction. The next point, as far as the board and employee and HQ matters, an important distinction here versus an IPO is that, and again, this is what allows oftentimes companies that may be a little bit sooner than the traditional IPO path, is there's the board and employee infrastructure, which can be sometimes synergistically incorporated into the private company as part of the deal. So oftentimes, the private company may not have public company financial reporting, regulations and kind of the oversight in-house, and that can be inherited obviously it's a negotiation with every party, but I've seen it, if you look back at some examples like the Cinta Madrigal transaction where the CFO was a public company CFO and actually transitioned and stayed with the public company post-transaction. So that was one from the reverse merger shell, but yet that critical employee stayed with the company post-deal as part of the new Madrigal entity. And, as far as board representation, if you have a company that's been public for a while, they oftentimes have, independent board members, very well-respected independent board members, which can be very additive when thinking about a private company who's looking to adapt their board to be public company ready. The next one down the list is, within the merger agreement itself, two big important structural points are the support agreements and the lockups. Just to make the point, the lockups generally look like an IPO, so there's not too much to be concerned with there. The important part here, but it's also nice that you don't have to worry because you get that cushion, so you don't have to worry about selling day one by large insider shareholders. And the other benefit here with support agreements, as far as getting a vote, if you have a lot of insider investors with significant shareholder vote, and especially sector specialists who are on the board or in the know and are willing to sign a support agreement up prior to signing of the deal, that can go a long way. And that is something where it's oftentimes pretty common for the private company to push to have the public company bring their largest or top two largest shareholders over the wall and or get them in some ways to commit to signing a support agreement for this transaction, even if they're not on the board. An interesting dynamic as far as the next bullet down on concurrent financings. Historically, these were always done opportunistically where the company was a little short with the reverse merger cash and its own cash to finance itself through the next clinical milestone. And so they would look to pursue, and that's obviously the number one goal, right, is to be fully financed through the next milestone in the public domain so there's no financing overhang. Oftentimes now what you're seeing is that given the amount of capital, frankly, that's flowing into the sector in the private and the public markets, it's much easier to have this happen. But what you're seeing is oftentimes you'll have a fully financed pipe that is actually announced concurrent with the signing. So there's no financing risk, and the board of the public company can go out and say that this is a fully financed deal, and which obviously adds a lot of credibility to the stock to trade right out of the announcement. And oftentimes, if it's not fully marketed, if it's not a marketed private process, which a lot of companies would be in the marketing process anyways and do this additively, the insiders of the private company are willing to sign some type of commitment to backstop any financing. So the deal is fully financed, but then they can go out and fully syndicate that or add additional capital to that round between signing and closing. So I think in the last year or so, that's been one major trend, really in the last 6 months even, where you've started to see these private companies come to this transaction fully financed, whether that's through a backstop or through a round that they're currently running. And then, downstream CVRs of legacy programs. In this case, I would just make the point that oftentimes simplicity is your best friend, and it's not always worth it to go down the path and pick your battles. If you have the majority, the public company, you can usually push to get, CVRs are obviously a little annoying to have to track and monitor. On the benefit side, they wouldn't have to be publicly traded. Oftentimes, you can just bridge the gap simply by slightly sweetening the economic split and or the benefit that the former public company has by merit of their ownership in the combined company for any future value inflection due to those public companies' assets. If we can flip to the next slide. And so just a few things to think about if you are a private company who's looking to pursue one of these reverse merger processes, whether proactively or opportunistically, even if you receive a call based on introduction from an investor or from a banker. As far as the preparation checklist, things you should have at your disposal. an updated investor presentation. The key focus here is going to be around key catalysts over the next 12 to 24 months. Every public company, that is what they're focused on in the private enterprise, of having real value inflection over that time frame. And when you think about putting in a proposal, having data points to support your proposed valuation. So any public comps or precedent transactions that can point to a valuation that would support your proposed valuation in that merger discussion. Audited financials, this is one that oftentimes holds up the signing and or closing of a deal. Being on the process or being closer to having audited financials in place is a huge distinction and very beneficial, and can make the difference, especially if a company on the public side is really looking to transact quickly. This is the one area where it can slow down the process, and frankly, if all things considered, may shine negatively on you as a potential candidate. And then the last point I would just make note of, obviously, or 2 points. One, the S1, if you've had it drafted and you're just deferring you're doing this because it wasn't the right time to go out, that's a huge plus. But the data room, and having a data room ready for companies to execute on their due diligence and being fully organized with that, so they can go about it expeditiously, is a big plus. And as far as what to expect in a process, these are pretty formally run auction processes nowadays. Usually you can expect at least 2 or more rounds of bidding, management presentations in the second round. You should expect, while everyone's looking to close this quickly, you should expect around 3 months from initial outreach to signing, and probably another 3 months between signing and closing. And one thing that you may be asked to do is to meet with some of the larger public company shareholders. That can sometimes that's your request, and sometimes that's just the public company wants that sign off before they are willing to proceed with you. And one other thing to keep in mind is that you may have to, especially if you're one of the finalists, you may have to actually mark up a contract and spend some legal dollars later in that process before getting into any kind of exclusivity, which is the last point. And as far as valuing the public company, I think it's important to understand that companies are looking to be valued at a premium to their cash. When you think about any kind of IPO or financing discount, typically 10, 20% as it is kind of your standard haircut. So some type of premium on that cash, whether that's done through an explicit multiplier on the cash. I've seen private companies bid that way. I've also seen private companies just ascribe a value to the listing, sometimes to the tech value, but at least a listing value of $3 to $5 million seems to be the norm nowadays, sometimes up to $10 million for value being ascribed just to the public listing. And when you think about cash, as far as these negotiations, you should be looking at cash on a net basis. So you should expect the public company's cash on a net basis, and there's definitely a strong way to push there to make sure that the net cash is really net of things such as D&O insurance on behalf of the public company side, like I mentioned earlier. And just the last thing to think about, this is all relative value, so it's less important. Public companies are less focused on the absolute value that you're ascribing to yourself and you're ascribing to them. What it really comes down to is the relative valuation and the relative ownership split. And then if we flip through to the next slide and look at what makes a public counterparty an attractive public counterparty, obviously sizable net cash balance, it should go without saying, but the more cash that the company has in the company, the more competitive the process is going to be, and the more attractive the counterparties are going to be that make it into the later stages of the process. Oftentimes, it seems like just a break thresholds for where you get a lot of interest and it's very competitive seems to be around the $30 million watermark. So if any company is leading to believe that they are going to have at least $30 million of net cash in the company post-transaction, then you should expect that you're competing against dozens of parties oftentimes, at least in those initial rounds. When you are looking, ideally you would find a concentrated shareholder base on the public company side. If you have one or two large shareholders that have double-digit ownership stakes in the company. This obviously just makes it, frankly, a lot easier to get the vote, but also, two, getting that validation can help, especially for any pipe that you're looking to do, and to convince other shareholders who may just follow the trends of those larger investors. And just going down this list, clinical operations and programs. Whenever you're thinking going back to the net cash, you should be arguing for any net cash net of all of those wind down costs and trial costs, assuming that you're not looking to continue those programs. If there is, the one benefit to a reverse merger is that there is potentially a benefit of those of the public shell of having some earlier stage programs, which may be synergistic to your pipeline, in addition to the management of the board. And the last one is, regular dialogue for the management with their key investors is a big plus, and that's something that you should try to ferret out earlier in the process. It makes the later stages of discussion and getting those insiders to go over the wall and to support the deal much more likely. And with that, I will flip back over to Brian.
Thanks, Evan. Appreciate it. With that, I'm going to transition now to legal considerations to think about. So next slide, thanks. The basic structure of a reverse merger is typically pretty straightforward. The most common approach is a reverse triangular merger. In this approach, the public company creates a wholly owned subsidiary, which is empty, so no assets, just a shell. And that subsidiary then merges with and into the private company. The stockholders of that private company swap their securities for shares in that public company. And that includes any outstanding preferred securities or convertible securities that the private company has outstanding. And so after that transaction then closes, the private company shareholders take a control interest in that public company, essentially. So the shares in that transaction are typically issued as part of an exempt private placement. So the recipients receive restricted securities, with the main advantage of doing it as a private that it's exempt from registration, and so it avoids the delays of going through the SEC approval process in connection with an S-4 registration statement. Alternatively, a combined proxy and prospectus can be prepared as part of an S-4. So shares can be issued in a registered transaction. But neither way, at closing, the private company ends up by being a wholly owned subsidiary of what was the dormant public company, which now essentially acts as a holding company to a certain extent. And that holding company then changes its name, gets approval from the stock exchange for the transaction, as I had mentioned before, and that becomes the new public company, wholly owning that previously prior private company. Other structures that we've seen are share exchanges, where the public company acquires shares in the private company in exchange for shares in the public company. As we'll show on the next few slides, this structure is more prevalent amongst issuers that include a foreign counterparty. The main concern in a share exchange is stockholder approval. Typically, in the merger context, approval is a majority of the private shareholders, perhaps 2/3, depending upon the organizational documents. There may be a separate vote for the preferred stockholders of that private company. They may have separate voting rights or separate approvals. All of that which needs to get diligenced and incorporated into the structuring option that's chosen. Less common structures that we've seen are asset purchases that have been done in certain circumstances. But regardless of the structure, the key point is that the owners of the privately held company receive equity and a control position in that post-closing public company. So the next several slides, Melissa, we provide recent precedents of reverse mergers that we've seen in the life science space, and we highlight, several noteworthy observations. As you can see on the slides, in those bullets, there's a number of consistent themes that emerge relating to the treatment of the public company's outstanding stock options. What about warrants? If warrants are outstanding, how are they treated? Lockup arrangements, Evan had mentioned, very analogous to an IPO, and you can see that reflected here. And termination fees. Very often you'll see termination fees like you would in any other M&A transaction. So these are all important legal considerations in the context of any reverse merger. Most often the dormant public company will have underwater stock options and warrants that will need to be taken into consideration from an accounting standpoint as well. And parties need to review the change of control provisions otherwise in the applicable equity incentive plan and any other contracts that the public company has, including and the private company as well. Very often the transaction will be considered a change of control, and everyone should be aware of the implications of that. Parties should also consider whether the public company's existing equity incentive plans will remain in effect post-closing, and if there are any available shares that can be issued under those plans, or if that public company, as part of its approval process, should be approving a new equity incentive plan so the post-closing company has the ability to issue fresh equity awards to employees and to retain executives following the closing of the transaction. With respect to lockups, typically we see 180 days, and the point of the lockup is to provide support and encourage the public company shareholders to affirmatively approve the transaction. Next slide, Melissa. So let's jump to structural considerations. So not surprisingly, it's much more expensive to become a public company rather than continue as a private company. So this needs to be taken into account. The significant transaction costs that are associated with the reverse transaction. As Evan mentioned, one of the benefits potentially is if a private company has already been thinking about doing an IPO and already has an S1 drafted, and that can be converted essentially into disclosure for the public company's proxy statement. That'll help save time. But very frequently, timing considerations relate to the preparation of the private company's audit and also preparing the required pro forma financial statements. Of course, for some companies, the increased expense of becoming public can be quite cost prohibitive. Sarbanes-Oxley needs to be taken into account, and those additional costs in order to set up, maintain, and have the necessary internal financial controls that are required need to be taken into account. Depending upon the timing and the facts and circumstances of a given reverse merger, we have seen the SEC waive certain Sarbanes-Oxley requirements for a limited period of time prior to the first annual report filing, but that's always discretionary. Public companies also have, as noted here, extensive public disclosure obligations that aren't applicable to privates. These include details on executive compensation, related party transactions, any regulatory problems or financial performance. All of this becomes part of the public domain. So obviously, companies that don't wish to have their information public and frankly being also viewed by competitors of the company have to take that into consideration. As noted here, public companies also are more likely to face litigation. It may be from the public company's shareholders. It may be from license partners or creditors. But the public company may feel the obligation to settle those litigations more quickly than they otherwise would, even if they have little or no merit. Okay, so turning now to diligence. Next slide. Excuse me. Diligence is, of course, a critical component, obviously, of any business transaction, and the reverse merger is no exception. So importantly here, there's two components to the diligence. You have the private company diligencing the public company, and the public company, very importantly, diligencing the private company, which is going to have the ongoing operations that are applicable. So with respect to the private company's due diligence, particular attention needs to be paid to the securities law compliance of the public company, accounting controls, legacy, tax, employee, any other liabilities, including environmental, that may have arisen from prior transactions that could have a lasting effect post-close of the transaction. Obviously, it shouldn't be surprising that dormant public companies in the situation that they're in may have a significant number of pending or threatened legal actions that could come up from a variety of different parties. So all that needs to be diligenced. Existing employment agreements should also be assessed. What are the aggregate payments that are triggered by that reverse merger? Presumably, a change of control will be triggered under the agreement. The amounts that are owed under that should be factored into the exchange ratio that Evan was describing that's used in the merger agreement. Of course, the other public company contract should be reviewed. And last on that list there, tax diligence needs to be done. So does the public company have any significant net operating losses that either will be completely or partially taken out as part of the reverse merger? The value remaining, if any, frankly, needs to be taken into account as part of that exchange ratio. Next slide. So on this slide, we note additional items that the private company should consider. Evan mentioned D&O coverage. Of course, directors and officers need to make sure that D&O coverage remains uninterrupted during the course of the reverse merger transaction. Private company D&O insurance is not going to just continue and shouldn't be expected to. So that needs to be coordinated with the carrier. Next slide. The applicable merger agreement that is used generally resembles any other M&A type agreement. Customary reps and warranties are included from both the public company and the private company. And M&A style disclosure schedules are also prepared. These may take weeks to put together, and time should be allocated for that accordingly. Of course, the private company reps and warranties need to take particular account of the ongoing business operations of the private company. Indemnities are also typically included. However, the private company's management should expect that any monetary remedies, pursuant to that indemnity may be limited, and it may be wise to create a escrow if necessary, if there are specific liabilities that the parties should be aware of and take into consideration. So turning to the next slide, concurrent financings. Evan had mentioned that the real rationale here for the private company is to obtain capital. That's partially the rationale, and what the dormant public company has may not be sufficient. So not all companies raise capital at the time of the reverse merger. Some do right before. Others do right after. But one of the benefits of the reverse merger transaction is that the private company can step into the shoes of the dormant public company and potentially utilize an S3 short form registration statement, as opposed to what Anna will talk about momentarily with respect to the SPAC alternative. A post-closing company in the reverse merger context can potentially implement an ATM or an at-the-market program or other financing arrangements off of its shelf registration statement following the filing of a Super 8K and the closing. With that, I will turn the presentation over to Anna to get into the SPAC alternative.
Thanks, Brian. So we'll go on to the next slide. Evan introduced this a little bit in his introductory remarks, and just to elaborate a bit more, there are now quite a number of different ways for a life sciences company to consider becoming a public company. And one of the one of the alternatives that has been written about the most in the last couple of months is a merger of a private company into a special purpose acquisition company, or a SPAC. So I'm going to try and distinguish the SPAC from the reverse merger into a shell company that Brian talked about earlier, and also contrast it a bit with the reverse merger into an operating company. And Evan can comment maybe as well and give his perspectives. So in terms of just thinking about what makes a SPAC different, a SPAC is a newly formed company. So it registers with the SEC, it undertakes an IPO, and its sole business plan is to go out and use those IPO proceeds to acquire and undertake an initial business combination with a private operating company. And SPACs have been around since the 90s. They've gone through many evolutions and have come back better and stronger in many respects. So we're seeing SPACs that are led by very high quality, very well regarded private equity sponsor groups, or by very well known and respected entrepreneur founders and founder groups. So definitely bigger names involved in the SPAC market, as well as financial intermediaries, underwriters that are helping these SPACs with their IPOs. And then of course, if you compare them to the generation of SPACs in the 1990s, there is more shareholder alignment now as a result of changes to the capital structure. And there are also some unique capital structure issues for some of the life sciences SPACs. So there are some notable changes. If we go onto the next slide, as I mentioned, the news about SPACs is kind of unavoidable. Were a lot of people, including SIFMA, in a recent report called 2020, the year of the SPAC, and you see IPO volumes there on the slide. And then on the next slide, SPAC IPOs accounting for almost 50% of IPO activity to date. We've had a few weeks of slower SPAC IPO activity, but I think that on the whole, it'll be a very, very strong year for SPAC IPOs. So if we go to the next slide, just a little illustration of how SPACs work. The company, as I mentioned, undertakes an IPO, raises a pretty substantial amount of capital in trust. Almost all of the IPO proceeds are put in a trust account. It goes out and targets a company. There are quite a number of life sciences focused or healthcare focused SPACs, and through an initial business combination, the private operating company target ultimately becomes the successor company or the combined company post completion of the initial business combination. All of this is subject, as we see on the next slide, to a shareholder vote. So SPAC stockholders have the opportunity to express their views and to vote for the initial business combination. They also have the ability, or the flexibility, I should say, to redeem their shares. They could also redeem their shares and vote for the transaction. So Brian was talking a little bit before about the alternatives in terms of SEC filings for reverse mergers into operating companies. It's not too different in the case of a SPAC. Most SPACs take the approach of doing a proxy on Schedule 14A and soliciting stockholder votes through the proxy statement. That proxy statement is going to contain information about the private company that's very much the type of information and the degree of detail and the same types of financial information and financial statements that would be in an S1. So again, to Evan's earlier point, if you have a life sciences company that maybe is well along its way to preparing an S1 and thinking about going public as a standalone enterprise, a lot of that work that went into preparing the S1 could also be used and would also be very helpful in the context of a discussion with a SPAC sponsor, and all of it can be used in connection with the proxy statement or prospectus that's prepared in connection with the SPAC initial business combination. There are a couple of things, we'll go to the next slide, that maybe are a little trickier, and often the financial statement requirement with respect to, in the financial presentation with respect to a SPAC transaction involves some closed questions, just as it does in connection with the reverse merger into an operating company. Depending on the terms of the arrangement, it may well be that for accounting purposes, despite how things are arranged from a legal perspective, the operating company could indeed be the acquirer and could be viewed as the predecessor from an accounting or financial statement perspective. There also may be pro forma financial statement requirements, as well as instances where the SPAC may have a different fiscal year from the operating company, or as a result of a number of changes, the historical financial statements might need to be recast. Just as is the case with the reverse merger into the shell that Brian talked about, I want to go maybe into a little bit of detail on one other point that comes up in both types of transactions, and that is both in the reverse merger into the operating company and also in the SPAC context. The proxy statement or the S4 will include a section that discusses the background to the business combination. And in that background, there'll be a discussion about how the board, again, SPAC board or public company board, came to identify the target and the various discussions, potential considerations of other target companies, the types of target companies that were considered in very generic terms, and then a fair bit of detail regarding the valuation analysis or analyses that were undertaken by the board or by the board with a financial advisor in coming to a valuation. And oftentimes, really almost always, there will be some forward-looking information or some projection information in both contexts, in the reverse merger into operating company and in the initial business combination with a SPAC. That raises some concerns for the company going forward. It's not usually the case that, for example, an IPO prospectus would never include projections, and a company would never put this kind of information out there in a regular way deal. So that's something certainly to bear in mind. So I'll go to the next slide. Brian talked a little bit about reverse mergers into shells. Historically, life sciences companies, particularly foreign life sciences companies, considered reverse mergers into shells. Those shell companies were relatively thinly capitalized and oftentimes were just OTC listed. That is very, very different from a merger with a SPAC. While technically, for SEC purposes, a SPAC does constitute a shell company. We're talking about a very different type of transaction, so it's worth emphasizing that. The SPACs that are getting done are large. They are sitting on substantial pools of capital that will be available to the life sciences company target. So they're very different in character. However, unfortunately, from an SEC perspective, there are some impediments, and these are worth thinking about, particularly for a life sciences company that's evaluating the SPAC route versus the reverse merger into an operating company. And that is that a SPAC is considered an ineligible issuer for SEC purposes. That means that for a substantial period of time, it can't use a free riding prospectus. It also can't qualify as a WIXI. And the inability to use certain free ridings will affect how a SPAC and how the continuing company, for so long as it remains an eligible issuer, can market in follow-on offerings, how it can market in connection with a PIPE transaction. For example, all of the roadshow presentations have to be live as opposed to taped roadshow presentations. It affects Rule 144, as Brian alluded to earlier. And if we go on to the next slide, it's also important for the legal and compliance groups at investment banks, of course, to bear in mind that as an ineligible issuer, the usual research safe harbors are unavailable. On the next slide, most SPACs are EGCs. However, it's important to consider both in the SPAC context and reverse merging into an operating company that both the SPAC or the operating company, the public operating company in the reverse merger scenario, will have used up, if you will, some of their time as an EGC. So you can remain an EGC in theory years. However, the private company, if it's going public through one of these routes, will have lost a little bit of that time because it will be looked at in conjunction with the SPAC or with the public operating company. So on the next two slides, we have a few kind of points of comparison. Brian alluded to the importance of diligence, legal diligence, diligencing contingent liabilities and potential litigation in the context of reverse merging into an operating company whose clinical program may have failed. Of course, diligencing a SPAC is quite straightforward and doesn't involve any of these considerations. Very rarely will there be any substantial contingent liability or any litigation. Likewise, with a SPAC, there are none of the issues that Brian mentioned relating to dealing with reductions in force or dealing with management or a legacy board. So in many respects, the process of merging with and into a SPAC may be somewhat simpler. Of course, a SPAC will have a more complex capital structure. And so that'll be a little bit of a legacy that the company will have to deal with going forward, as well as, of course, issues relating to perception. So maybe I'll pause there and just let Evan comment in terms of these alternatives in case there's anything that I missed or that bears highlighting?
Sure. I think, look, the biggest thing here is I think where the market has kind of gone very recently, these have shifted to look very similar. So as I mentioned, where it used to be that one of the benefits of the SPAC was that you would have the ability to market the deal and get a concurrent pipe announced with the signing, you're starting to see that with reverse mergers as well. In the life sciences SPACs in particular, well, traditionally with SPACs, you have significant warrant coverage. And what you've started to see with the life sciences SPACs is that a lot of the recent ones that are life sciences focused investors have been done without any warrant coverage at all. So you start to see a lot of them merge, and they look very similar. And you know, a lot of times when you're looking at the other one should also be considered. You know, the dilution impact the SPAC sponsors are now willing to take less of the dilution on that side as well, and sometimes they're willing to backstop the pipe as well. So again, all these factors make them start to look similar. And I think it's a trade-off between there are some benefits where, especially if there's a management team or specific assets that you find relevant on the reverse merger side, it could be helpful. It's a little bit easier to do, I think, for a broader range of companies in the sense of most SPACs, given the dynamics of the promote and how dilutive that is, tend to be much larger transactions. So whereas you could do a reverse merger with $20 or $30 million if that's all you needed, and you could be a smaller company and still maintain a decent share, it's not really open. The SPACs aren't open to as many companies.
So thanks so much, and thank you to Evan for making time to join us for today's presentation. We really appreciate it.
Thank you.
All right. Thanks so much.